Good morning, everyone. I want to welcome everyone participating in today's webinar, Prepare for the Changes Ahead for Employee Benefit Plan Audits. My name is Omid Mohebi, and I am a nonprofit audit supervisor at Gilman, Rosenberg & Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CP credit. Participants seeking CP credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall 3 CP words in order to receive credit. Please write down the CP words when they are given and keep them until you receive your certificate. They will not be provided again. These CP words will be given while participants are answering the polling questions. That is your cue to listen for the CP word. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. You will also receive a follow-up email with direct links. Technical support and CP questions may also be addressed to Dominic Acosta at dacosta@grfcpa.com. Today's learning objective is to understand the upcoming changes to employee benefit plan audits. There is 1 CP credit available for this webinar. Now, I would like to introduce your presenters for today's webinar. GRF's managing partner, Jackie Cardello, is a nonprofit audit partner and the director of employee benefit plan audits. Ms. Cardello provides leadership and oversees strategy and governance to ensure exceptional client service and success of the firm. Ms. Cardello was recognized by City and State New York with their annual The Responsible 100 Award, honoring an elite group who set new standards of excellence, dedication, and leadership in improving the communities. Jennifer Arminger is a nonprofit audit partner. Ms. Arminger has worked in public accounting for her entire career and possesses expertise in auditing and accounting for tax-exempt organizations. She is a frequent speaker in compliance with uniform guidance and leads a seminar and webinar series aimed at bringing financial management education to Maryland, DC, and Virginia nonprofits. In addition to her role as an auditor, Ms. Arminger is also a leader in the firm's employee benefit plan practice, ensuring clients' compliance with the specifics of various plan qualifications. I will now turn over the presentation to Jackie.
Great, thank you, Omid. Welcome everyone to our webinar about employee benefit plans and understanding the changes ahead. Before I dive into all of the requirements and the things we're going to cover, I'd like to go through the agenda. So the first thing we will cover are requirements for an audit. When does your plan need to be audited? What triggers that? We will go through the proposed changes to the employee benefit plan audits. And then we will also address some common issues and errors that we see in employee benefit plans when we're doing their audits. So to start off, before we get into the requirements, I'd like to know how many of you out there in our listening audience know whether or not you are subject to an audit. So I'm going to go ahead with poll question number 1. Are you currently subject to a retirement plan audit? Yes, no, or if you're not sure, answer I don't know. And we'll give you just a minute there to answer those questions. Now I'm going to turn it over to Omid. Go ahead, Omid, with the polling question answers.
Thank you, Jackie. Please take a moment now to answer. While participants are submitting their answers, I'll provide the first CP word. The first CP word is retire. If you want to receive CP credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CP word is retire. Excuse me. I will now hand it back to Jackie for the results.
Okay, so we have 41% of our attendees said yes, that they know they are subject to an audit. 37% said no, and then we have 22% that said I don't know. So we're going to go to the requirements for an audit. So very good. Thank you very much for participating in that. So first of all, when do we need an audit of our retirement plan? One of the important things to know is, what is ERISA? ERISA is the Employee Retirement Income Security Act of 1974. And it's basically a federal rules that govern employee benefit plans. And ERISA was designed to protect the participants of the employee benefit plans to ensure that they receive the benefits that they're promised by their employer. And ERISA is basically enforced by both the Department of Labor and the IRS. Okay, so Title I of ERISA is the section of ERISA that addresses benefit plans that need an audit. The general rule is that when your plan reaches 100 participants or more, which is measured at the beginning of the plan year, your plan is subject to audit. So if you're on a calendar year plan, as of January 1st of each year, that is your measurement date, okay? You're measuring it on a 100 participant threshold, and it's important to understand who qualifies as a participant under the IRS definition. It's not simply just the number of employees you have at that particular point in time. So a participant is defined as active employees who are participating in your plan. It also includes terminated employees who still have account balances that remain in the plan. So if you have someone who terminated 10 years ago, but they still have a balance in your plan, they are considered a participant. And also active employees who are eligible to participate in the plan, even if they elect not to. So that's why it's good. We see more and more plans with safe harbor provisions in place and profit sharing to try and get as many employees as possible to participate, because if you have employees who are eligible and not participating, they still count as a participant. And frequently we do see terminated employees with balances and active employees not participating, driving up the numbers over that 100 participant threshold. So now let's talk about the 80-120 rule. So the general rule is 100 participants. Once you hit that number, you're subject to an audit. However, each year, a plan that fluctuates between 80 and 120 participants can elect to file the Form 5500 in the same category as you did in the prior year. So, for example, if you were a small plan and a small plan files the short version of the 5500, where an audit is not required if you're under 100 participants. Large plan is considered 100 participants or over, you file the full 5500 with a Form Schedule H, and an audit is required to be attached to that filing. What the 80-120 rule is designed to do is to give a little bit of leeway to employers, to smaller employers who frequently fluctuate right around that 100 participant mark, so that you're not triggering an audit one year and then the next year you don't need it, and then you need it the next year and you don't need it the year after that. It can become an administrative nightmare. So this is designed to offer some protection so that you have a little bit of cushion there. So let's say you have 98 participants at the beginning of your plan year in 2017. You are a small plan, not subject to audit. And then let's say in the following year, your participant count goes up to 112. Because of that 80-120 rule, even though you are past that 100 participant mark, you can still elect to file the same way you did the year before. And the year before, you filed as a small plan because you had under 100 participants. So you elect to file as a small plan, you do the short version 5500, you do not need an audit. Once you hit that 120 participant mark and you exceed that, you are now considered a large plan. and you would be subject to audit. And the only way to then go back to being a small plan is to once again go below that 100 participant count. So now let's move on to which plans are exempt from the audit requirement. Again, 100 participants being the general rule. However, if you're a governmental plan, a church plan, or you have a safe harbor plan, you are not subject to ERISA and therefore not subject to audit requirement. Governmental plans are those established and maintained by a governmental agency of the U.S. Church plans established and maintained by a church or by a convention. And a safe harbor plan, not to be confused with the safe harbor plans 401k or 403b set up to meet matching requirements so that you can forego non-discrimination testing. This is a type of plan that is funded solely through salary reduction. And this came into play when 403b plans were initially subject to the same requirements as all other plans back in 2009. So you meet the definition of a safe harbor plan if you are solely funded through salary reduction agreements and are not maintained by the employer. Maintained being in quotes because there is a definition there. And if you're unsure if you have a 403b plan that's considered safe harbor, feel free to reach out to us. We can help you with that. And also your third-party administrator should be able to help you as well. But basically, it's usually a 403b plan that is set up with, and it's only funded through employee deferrals. So only the employees contribute. The employer doesn't contribute, they don't match, they don't oversee the plan. It's usually through insurance contracts that are allocated to the individuals. They own the contracts, they're in charge of their accounts. The employer, all the employer does is facilitate by means of basically giving the participants the information and having them take it from there. So again, if you're unsure if you have that type of plan, we can help you with that. But those are the only 3 types of plans that if you're 100 participants or over, you are not subject to the audit requirement. Now we're going to move on to polling question number 2, and I will turn it over to Omid.
Thank you, Jackie. We have now come to our second polling question. If your plan is subject to audit, does your plan qualify for a DOL Limited scope audit? Please answer A, yes, B, no, or C, I don't know. While participants are submitting their answers, I'll provide the second CPE word. The second CPE word is audit. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is audit, A-U-D-I-T. I will now hand it back to Jackie for the results.
Thank you, Omid. Okay, so results are in, and it looks like we have a fair number of participants who do not know if they are subject to a DOL limited scope audit. Some of you answered yes. A fair amount said no, and there are a group of you that said you don't know. So I am now going to turn the webinar over to Jennifer, who is going to go into the employee benefit plan, the proposed changes ahead, and she is going to cover what a DOL limited scope audit is. Okay, Jen.
Great. Thanks, Jackie. Yeah, so we are going to transition into some future proposed changes for those plans that do receive an audit. So we did just hear Jackie talk a little bit about when the plan is required to get audited, which was an important piece to kind of preface the changes that are coming down the line. So if you already get an audit or you know you will cross that 100 participant threshold relatively soon, this will apply to you. And I assume that's why a lot of you have joined us today to listen in on the changes that are ahead. But I think it was important to also take that polling question before we got into this, because it was the first mention of a limited scope audit and we will continue to focus on this type of audit. The changes focus a lot on limited scope audits. So I think it's very important to clarify what that is, especially because a lot of you answered no, that you don't qualify for a limited scope. But I think a majority of you might, given the context of what it is. So when you are subject to audit, when your plan is subject to audit, management can elect to have what's either referred to as a full scope audit or a limited scope audit of the plan. So a full scope audit is an audit where the auditor will issue an opinion. They audit everything within the plan. There is no scope limitation. What a limited scope audit is, it is under the DOL and ERISA's guidance. They find this completely acceptable and have issued guidance that employers can elect to have this type of audit, is that the auditor is instructed not to audit the investment information, the investment valuation for those investments that are held in a qualifying financial institution. Okay, so let's say, for example, your investments are held at Fidelity or with TIAA-CREF, and they're acting as a custodian or a trustee on your behalf, and they have done the valuation of the investments and provided you with an audit package of the investment information and the roll forward of the plan activities, and have issued a certification that they are certifying to the completeness and accuracy of that investment information. And so us as the auditor would rely on that certification and not audit that piece of the plan. Now, in doing that, we're not auditing a material piece of the plan, and therefore we disclaim the audit opinion under the current standards. We'll talk about the changes ahead with respect to that. So we've disclaimed the opinion. It's completely acceptable. It's fine. And so what the auditor does focus on in a limited scope audit is all the other pieces, components of the plan. So contributions, allocations of the investments and the contributions, or distributions and things like that. So it's just limiting the scope with respect to the investments held in those qualifying financial institutions. So I think that was an important piece that we distinguish, because I would say that for our employee benefit plan practice, I would say at least 90% of the plans that we audit are being audited under that limited scope engagement. It's less burdensome on management, and the fees can generally be lower. So it's an easy choice when that option is available. So what we'll be talking about in the next couple of slides is this new accounting standard, and it is titled Forming an Opinion and Reporting on Financial Statements of Employee Benefit Plans that are subject to ERISA. And so, you know, this exposure draft, it was actually created and proposed by the AICPA in response to the DOL criticizing the results and findings of a 2015 study that was done, which we'll talk about in a little bit more detail on the next slide. But overall, it's generally to improve the quality of the type of audits, the consistency of those audits, the results, and really putting some things back on management to own when it comes to the plan processes. So as of today, the ASB, which is short for the Auditing Standards Board, board of the AICPA, has voted to issue this standard. So they did that back in mid-December in 2018, so just a couple months ago. And they issued the standard in a form of a final balloted draft. So materially, nothing in here is going to change. It's going to be formally issued, but it has not been finalized, just pending some slight changes early this year to align with some other work that they're doing. And so we do expect this to be finalized relatively shortly, because it will ultimately be effective for the fiscal plan years on or after December 15th, 2020. So what that really means is that if you have a calendar year-end plan, this will be applicable for next year's plan audits. So December 31st, 2020, which those audits usually occur in mid-2021. So coming down the line, still a little bit of time, but here it is, April 2019 already, and it will fly by. So want to get you all prepared for those changes. So we mentioned previously the new standard is in response to this study that was issued back in May of 2015, in which the DOL and EBSA, the Employee Benefits Security Administration, had spent time, a couple years, reviewing over 400 plan audits that were of all sizes, so big plans, small plans, in conjunction with the CPA firms, big firms, small firms. And what they found was that approximately 30% of those audits were deemed deficient by their standards. And so a very shocking and high rate of deficiency. And they really kind of spearheaded, okay, we need to do something about how these audits are being performed and the quality of these audits. And where they saw the biggest deficiencies really were in those limited scope audits, and the CPA firms not doing any test work. So obtaining a certification and relying on that for 100% of their work. And so they didn't do anything. They draft financial statements and issue the plan. And that was certainly not what the intention behind allowing a limited scope audit was. And so when we start to dive into these changes, you'll see that is a very clear trend throughout all of these changes, is to clarify a little bit more on the work that should be done in a limited scope engagement. So, so starting with some of those changes, first and foremost, the new standard addresses the engagement even before the audit commences. So right at the engagement acceptance on both the auditors and management's part. So management will now have to sign a statement to ensure it understands that management is ultimately responsible for the administration of the plan. Management's responsible for compliance with the plan and maintaining the records. And so it's got this very clear kind of vibe that it wants to put that responsibility back on the employers, on management, because as we all know, a lot of this work is being outsourced through either a TPA or the custodian or the trustee, but ultimately it is the employer's plan, it is management's responsibility even to oversee these big reputable firms that we think are doing the job on your behalf, but may have errors in their design and implementation of controls. And so they now will require that signed statement in writing, as well as management to go through an evaluation of whether they can even elect to have a limited scope audit in accordance with the new standards. And so a lot of times, management could just assume that the certification extends to all the material and important pieces of their plan. And so this new standard will devise a statement and a procedure by which management has to go through and describe the procedures they performed to elect to have that limited scope engagement. And so that is going to be obtaining the certification, reading it, understanding what it does cover, what it doesn't cover, and making a statement that they are going to rely on that and they think it's sufficient to be able to cover a piece of the audit that their auditors will not be auditing. So that's a change, only because it technically should be done as of now, but typically that usually falls on the auditor to do, or typically management hasn't really obtained those certifications in advance and looked at them or signed a statement to the fact that they've evaluated it for accuracy and completeness. So that will be a change coming down the line for you all. A second clarification or enhancement that the standard addressed, and this is more on the auditor side, but I will just mention it because it does speak to kind of management's responsibility for engaging high quality audit firms. But the second standard really addressed a risk assessment and documentation with respect to any risks or those areas that we are auditing that of material misstatement or noncompliance. And so again, that I mentioned, this kind of falls back on the audit firm to make sure that they're going through and saying, okay, we think these are the key parts of the plan, and that we think there's risk in material misstatement or noncompliance, and then tailoring the audit procedures to be able to perform to minimize those risks accordingly. But as I mentioned, a lot of this piece kind of circles back to you all and to management, in that you really want to make sure that the audit firm that you're selecting does have the quality control in place to be able to understand their responsibilities under the new standard, and that they're doing everything they need to do with respect to these new plans. And then just one sidebar, and the final kind of change for the auditor is to read the Form 5500 for material inconsistencies. And so, the last two, the risk assessment and the review of the 5500, they're most often happening in practice with those high quality audit firms. But what this standard is really doing is formalizing it and requiring firms and management to make those affirmations and statements that they have actually done these things, which will ultimately be incorporated into your audits. So they hope by making the firms and management put these statements in writing, that it will force organizations and plans to self-audit and to improve consistency and the quality, and to really kind of take a look at what they need to be complying with. So a couple more changes, some of the bigger changes. First, that limited scope. This new standard will create a different audit opinion language when you elect to perform a limited scope audit. And they actually take away this phrase that we keep saying, limited scope, but the new standard overrides that phrase, and it should be and will be referred to as an ERISA Section 103A3C audit, and that will be the specific language within the new audit opinion. And they also hope, which I personally think that this is a good thing, because for users of these financial statements under the approach that we audit now, when you do see that disclaimer of opinion, it has a very negative connotation. Why it's almost worrisome to management and to governance who may not understand the intricacies of a plan audit to have a disclaimed opinion on a set of financial statements. And so instead, this language will kind of remove that disclaimer of opinion and instead allow the auditor to express a new form of opinion that's very unique to this ERISA Section 103. So I think that that's actually a really positive change that will really help when we're educating the users of the financial statements, governance, and things like that when they're looking at these plan audits. We've really already mentioned the additional work on the certifications, and that starts at the management level and will flow through to the auditor level. And so that will have to be documented, and we'll have to communicate in writing at the end any exceptions. And if you can't get a certification or the certification deemed insufficient, which we do have several clients who have been unable to obtain certifications. And in that case, you will have to have that full scope audit prepared. And that means the auditor will extend additional procedures, more testing all over that in the investment activity. And then finally, there will be requirements to opine and communicate in writing on compliance with all of the things within the plan. So we'd have to report on whether the specific plan provisions, whether the organization complied, and then document in writing governance if there were any findings. And so again, this is something that has been happening in practice, but where this kind of revision of the new standard focuses on is not necessarily on all the things that we didn't do because of the certification, but it actually makes us communicate all the things we did do. So opine on this piece of compliance with this plan provision and this plan provision. And if there were any exceptions, document that in writing. And so it's really focusing on all of the other pieces of the plan that need to be audited when opting for that ERISA Section 103 audit, or the limited scope as we so commonly know. All right, so that was a lot in just a little bit of time on what's hundreds of pages of documentation on the new proposed changes. But we thought we'd give you a taste of the more challenging or more robust changes that you all should be aware of, and certainly should plan with your auditor to address for next year's audits. But we do want to mention also there are some proposed changes out there on the tax form 5500. So Jackie really started to talk about that form that's filed for the retirement plans. And again, just to reiterate, the small plans, so if you have less than that 100 participants, you file the short form or a very condensed version of the 5500. And if you have the more than 100 participants, you have an audit. You file that full form 5500 with Schedule H. But the form is really ultimately what provides the IRS and really the DOL and ERISA and PBGC with its source of information about the plans that are out there in the country, and really the types of the investments that are held in these plans. And so it's a very important tool for the IRS in data gathering. So when we talk about changes to the 5500, there certainly haven't been substantial changes in a number of years. These were actually proposed back in 2016 and are still pending. They've been pretty quiet and really haven't made any significant efforts to revisit these changes, but we anticipate they will in the next year, only because the proposed changes were supposed to start with the calendar year in this year, 2019. And what we saw is that the Tax Cuts and Jobs Act passed in December of last year took a lot of the IRS's and DOL's focus and capacity, and they really pushed this to the side, but because they have proposed these changes for 2019, they should and will be revisiting it in the next year. And so we wouldn't anticipate this to go into effect until 2020 at the earliest. But why I think these are important is because for the organizations that this will affect, it might be significant, and you all can use this time to really prepare for the changes and do some self-auditing so that when these are implemented, when they do go into effect, that you all are ready and more importantly, have what these changes will require or will suggest is good compliance. And so diving right into the first proposed change on that 5,500. So ERISA and the IRS and IRC will propose a number of new questions regarding plan operations, service provider relationships, and financial management of the plan. And so what this is really getting at is they're going to propose questions that they consider best practices within the plan, within the relationships, within the management of the plan. While they won't be required, it's very much like the changes that were incorporated into the 990 a couple years ago. The IRS really thinks that these are best plan practices, and the more yeses you have, yes, we have these best practices in place, the less they'll be concerned. But once you all start answering no to several questions, does that trigger a further look by the IRS or the DOL? We don't know. I mean, that's probably the intent, but there will be a number of these items that they will incorporate in here that they would consider best practices, and really, those are the things that you get by going through an audit, the things that we see as hot topics, what the DOL is really looking for in plan compliance and things like that. So those will be coming down the line. It also aims to just, besides modernizing the whole form, but modernize the financial statement section and the investment information, particularly, the types of investments that we invest in today, that the plans invest in today, that are available in the market today are very different than the types of investments that were common and available over a decade, 2 decades ago. And so right now, when you're completing the form, in some of the sections, you almost feel like you're trying to fit a square peg in a round hole and kind of guessing, yes, this is the best place for this type of investment. And so it really hasn't caught up to the types of investments that are available today. And so that will certainly be improved and align more with what we're seeing is most common in practice these days. It will enhance the accessibility and usability of the data fields, and so making those data fields more readable for computer analysis. It will improve the certification requirements for limited scope audits, which very much aligns with the new standard that we just went through. And it's going to update the reporting requirements for service provider fees and expense information, which, if we've all heard about the increased responsibilities and fiduciary responsibilities and the enhanced transparency and accountability for this type of information. And so they'll really want to capture that on the Form 5500 as well. And then finally, what I think is probably one of the more onerous and robust proposed changes relates to the group health plans that are out there. And specifically, right now, those group health plans that have fewer than 100 participants don't have to file anything. But this standard does propose that that will go away and that there be some sort of filing requirement. And where the concern is that for those that do file now, the filing requirements and the information provided is very robust. And so the ability for small companies, small organizations that have less than 100 employees in their group health plan to get that type of data from the insurance companies and the plan providers, it would be very difficult and onerous and burdensome to be able to get that. So they've have proposed or trying to figure out if there will be a condensed version if they do require small plans to file those. And with that, I will turn it over to Omid for the polling question.
Thank you, Jen. We've come to our final polling question. Has your plan audit ever resulted with errors or findings? Please answer A, yes, B, no, C, I don't know. Please take a moment to answer. While participants are submitting their answers, I'll provide the final CPE word. The final CPE word is result. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the final CPE word is result, R-E-S-U-L-T. I will now hand it back to Jennifer for the results.
Great, thanks, Omid. And here we'd see the majority of you said you haven't had any findings, which is great. Some of you have. But really, as I mentioned before, having an audit and having your auditors make recommendations, or if they do find an instance of noncompliance, is really going to help you prepare for these changes in which the DOL and the IRS would also kind of trigger, if you weren't in compliance, could possibly trigger an audit or further examination. So those findings do help you clean that up prior to any implications from the IRS or the DOL. So with that, I am going to hand it over to Jackie to kick us off with some of our more common mistakes that we see in plan audits.
Very good, Jennifer. Thank you. Okay, so common mistakes, something that we probably don't want to think about or talk about, but a lot of plans have them, and it's not the end of the world. It does happen. And it's important to understand that the DOL is there to help you. They really want to see employers and the benefit plans succeed and comply, and they have a lot of tools in place to help you comply. So if you think that there's a mistake in your plan or you have a non-compliance issue, there are ways to correct it. And again, it's not the end of the world. They would rather you correct it in good faith, make a good faith attempt to correct it and document that it's corrected rather than ignore it for fear of what the repercussions would be. So with that being said, one of the most common errors we see is untimely remittance of employee contributions. We do see that quite a bit, and if they meet certain criteria, they have to be reported in your audit. If you're subject to audit, they get attached to the audit in a schedule of late employee remittances. And there are a few common misconceptions that lead to sometimes these late remittances. The regulations mention the 15th day of the subsequent month following the contribution as the absolute maximum time frame. It's very important to note that is not a safe harbor. It is not intended to be a safe harbor by the DOL. The regulations, what they are meaning, and if you read further and do some more research, their intent is that, and it does specifically say this in the regulations, that as soon as those funds can reasonably be segregated from the funds of the employer, they must be remitted to the participant accounts. And what we've seen is we've had plans that have gone through audits. And what they look at a couple of things. They're going to look to see if you have a policy in place addressing when those contributions are to be made. One, and two, if you have a policy, if you are in fact following it. And then they will also look at the reasonableness of your policy. They will look at your internal control structure. They will determine how quickly they believe that you're able to get those contributions remitted, and they often look to payroll taxes as the standard. Excuse me. So how quickly are you able to get your payroll taxes submitted? And they will also look at the trend. So if you have a trend and your contributions are sort of all over the place in terms of timing, so say 1 month, or one pay period, you get it in within 2 days after the pay period. And then the next pay period, it takes you 10 days. And then you're back to 4 days. And then another time you're at 20 days. They're going to look at that, and they're going to look at the earliest time frame within which you were able to submit those contributions, and they will deem that as your standard, assuming it's in a reasonable amount of time, okay? If it's 10 days, they will probably come back and say that's not reasonable. We're going to shorten that time frame. As a matter of fact, I've seen them do that. This was many years ago with one of my clients who did have an audit, a surprise audit, and they looked at their contributions, and they found the earliest date was somewhere between, I think, 6 and 7 days, and they said, we think that you should be able to get them in within 5 days based on your internal control structure. And so what happens is they will establish what they think is your standard, and they will consider anything beyond those number of days late, and you will be penalized for that. So it is really important, one, to look at how quickly you are really able to get those contributions in. And with technology now, it is possible, I think, to do it in 2 days easily. Form a policy and stick to it. Make sure you get those employee contributions into those accounts as quickly as possible. Because what happens is that's considered a prohibited transaction. If the employer is holding those funds, it's considered a loan to the employer. The employer is a party in interest, and that is not an allowed transaction for the employer to take a loan from the employees, and that's really the way they look at it. Okay, so important to note that, and just remember the earliest date you're able to make it in, be consistent with that date, because they will look at that earliest remittance date as your standard. So that's one type of error that we see. Another type of error is with the definition of compensation in a plan. So oftentimes it will specifically include or exclude certain benefits from the base for calculating your employee and employer contributions. It's important that the plan defines matches based on what is happening in practice. So you need to make sure what is happening in practice follows exactly what is written in your plan document. Because if you have a plan document that defines compensation one way, and in practice you are doing your employer matches based on a different definition of compensation, you now have an operational non-compliance because you're not complying with a plan document. And some of the common inclusions or exclusions are, for example, overtime pay or bonuses. Don't just assume that it's based on W-2 wages, because unless your plan document specifically indicates that, then that's not always the case. So make sure that you're clear on what that definition is and that you're following that when it comes to contributions, and it particularly has an impact on the employer matching and profit sharing piece. So we're going to go on to a couple more, and I'm going to turn it over to Jennifer again to finish up with the common mistakes and errors.
Great, thanks, Jackie. And Jackie really started on this next item, and hers was specifically on that piece in compensation on the plan, but really where we oftentimes see errors or plan non-compliance is when anything in the plan document, so not just compensation, but anything that's written in your plan document differs from what is actually happening in practice. And so we do see this happen quite a bit, and what what you also need to consider is that, if there are amendments or changes in practice, that it not only flows through to your manuals or your internal communication, but the actual formal legal document, the plan document or the adoption agreement that governs the activities in your plan. And so that could be changes that you all elect. It could also be there are frequent changes in the laws and regulations that you would need to amend, and specifically restatements. And so, I don't know that everyone is aware or addresses this as commonly as some of the other requirements in the plans, but there is a requirement by the IRS to restate your plan document ever so often. And I believe for if you have an individually designed plan, so a plan that was written just for you by an ERISA attorney, those are required to be restated every 5 years. If you have what's called a pre-approved plan, so it's a volume submitter plan, and there's a basic plan document, and you're the employer filling out the adoption agreement to adopt certain provisions of that basic plan document. That is actually required to be restated every 6 years. And so, making sure that you are following those guidelines and restating in the appropriate matter of time, we also see that occur. And if you do, and just a reminder, if you do have a 403B plan, it's been several years since there was guidance issued that you're required to have an audit, that it came subject under Title I of ERISA, and the IRS gave some time reprieve to kind of get everything in order because these weren't regulated before. But they have actually issued guidance that this reprieve period is expiring by March 31st, 2020, under Revenue Procedure 2017-18. So that will require 403B plans to adopt and they only have issued guidance on volume submitter plans, a formal approved IRS pre-approved volume submitter plan by March 31st, 2020. So if you do have a 403B plan and aren't aware of that, I would, we're here to help if you guys have questions after the fact, but that is required in little less than a year. It'll be here. My goodness. All right. And the final thing that we just want to kind of bring to your attention is what often happens is that sometimes you aren't even required to, or know that you're required to have an audit. So probably not you all, because you are here listening to the webinar today and educate yourselves on how to best comply with plan provisions. But sometimes employers go to file their 5500, and nowadays everything's electronic and it gets kicked back. The system says, nope, you actually need an audit. Where is that? And it's now July 31st or October 15th, and you don't have an audit. And so, you fail to file the necessary financials with the 5500, and you accrue penalties and interest until you can get that audit done, which takes some time. You can obviously apply to get some reprieve on those, but anyway, it does happen often. And with some examples of where we see this is specifically in some of the government contractors that we work with. And let's say you're awarded a very large new contract and you bring on tons of new hires. And after a 3 months probationary period, everyone starts contributing to the plan. And all of a sudden you have 100 new participants in 1 year because of a large contract. And so it is, be mindful monitoring that, and when you are required to get an audit. And so while there's certainly a lot more issues than these 4 that Jackie and I have gone over, we really wanted to focus on some of the ones that we see most often. Some of the ones that the DOL has really tagged as hot topics for them, like the ones that they're looking for, like the timely remittance, the definition of compensation. That is on their radar. They want plans to comply with that. But there's obviously a number of other items that could come up, and really can be easily avoided if you know what to look for. And so we're always here to help. But if with that, I'm going to go ahead and conclude the presentation portion and turn it over to Amit to see. We have some time left, so hopefully we can address some of the questions that we've gotten during the audit.
Thank you, Jen. As Jen said, before we wrap up today, we'd like to answer a few of the questions submitted by our online participants. The first question we have: once our plan requires an audit, what can we do to avoid the audit requirements in the future?
So Jackie, I could start, and then you could jump in.
Sure. Yeah, that's
Okay.
fine.
Yeah. So once your plan crosses that 120 participant threshold and you're now required to get an audit, I think Jackie mentioned that the only way that you would then not require to have an audit is if your participants fell below that 100 threshold, and that is as of the beginning of the year. And so, unless participants, they're not required to take their money when they leave your organization. I've had some clients try to reach out to every terminated participant and ask them nicely to roll over their funds into another plan so they can get below that threshold. But really, unless there's a termination, a restructuring, the org, and a lot of those balances and participants exit the plan and bring you under that 100 participant threshold, you will be required to have an audit moving forward. And Jackie, I'll let you kind of jump in there too.
Sure. Yeah, that's very well said. Yeah, basically what we see plan sponsors do, again, you can set a threshold, and there is a maximum which you can set that will force out participants if they're below a certain balance. And then, because sometimes we do see plans that don't have that. They'll have a lot of individuals that have high balances that are still in the plan, and if you are able to lower that balance, a lot of times you can force them out. And the other thing is just really encouraging people to participate who aren't, or changing if there's any way you can change. There's not often a lot you can do to change eligibility requirements, but eligible employees not participating, again, that's another issue. But there isn't a whole lot you can do once you meet that trigger, once you trigger that audit, unless you can get below. You've got to get below that 100 participants. And again, not too much you can do about that, other than try and get participants, as Jen said, to withdraw their funds and transfer them to another type of IRA or something.
Okay, thank you, Jackie. Question number 2. If we find that there was an error in the plan operations, what should we do, and who do we need to notify?
Okay, so I can start with that one. Basically, what you should do is immediately work with your plan administrator if you have a third-party administrator, because they're oftentimes able to help. If they're not, in fact, the ones who found the error, they can usually help you give advice on correcting it. But you can do a couple things. In many instances, we recommend contacting an attorney who specializes in ERISA. There's a lot of them out there. We keep a referral database of them. They are the experts in terms of the legal issues and how to remedy them. There's also the Employee Benefit Plan Administration website. If you go on the DOL website, it'll direct you to EBSA. And there's a lot of information on that website about the various different types of non-compliance matters that come up and the solutions for them and how to correct them. And there's some programs that you can partake in. So for example, the delinquent filer program, and what that's designed to do, again, I mentioned this in the beginning, is for employers to basically, go forward to the DOL. It's sort of mea culpa. We've committed this error. Forgive us. We'll work with you. And the DOL really is very lenient. It's their way of showing lenience to the employers who go forward to work with them to make a good faith effort to correct these errors. If your plan is audited, of course, always notify your auditor, because we're often able to point you in the right direction of what you can do to correct it. It could be that we've seen some issues where, for example, the wrong definition of compensation was used. So we had some employees who either were not correctly given the benefit, there was not a deferral or an employer matching or a profit sharing because the wrong definition of compensation was used, or employees who were given too much based on an incorrect definition. And then there are ways you can correct that. So for example, you can either make a contribution to basically level everyone out, where you're contributing to the rest of the participant population to make sure that everyone was evenly received the same type of benefit. And then you can also go back and you can actually retroactively amend your plan. You need an ERISA attorney to do that, and it's not as ominous as it seems. It's actually fairly easy, and can cost a little bit of money, but it's worth it if you want to go back and retroactively amend your plan so that you include that definition of compensation you were using in practice, and that way going forward, you'll just follow that definition going forward. So there's a couple of ways of correcting, but the most important thing is to let your auditor know, let your third-party administrator know, and if necessary, contact an ERISA attorney and they can guide you in the right direction. Jen, do you want to add anything to that?
Nope, I think we're out of time, so we're going to turn it back to Omid.
Thank you, everyone. We'd just like to, if you have any additional questions after today's program, please reach out to us. Our contact information appears here. And we'd just like to give you some information about some upcoming events and alerts. We'd like to thank everyone for attending today's webinar. We encourage you to follow us on social media at GRF CPAs and visit our website, grfcpa.com, for upcoming events and alerts. And finally, please remember to complete the emailed survey that follows if you would like to earn CP credit for today's webinar. Thank you again and have a great day. Bye-bye.
Thanks, everyone.
Thank you, everyone.